Welcome to Section 2 of the Federal and State Income Tax 2026 training series. In this section, we move beyond income and deductions to explore the powerful tools and parallel systems that shape your final tax bill. Itemized deductions under the new SALT rules, individual tax credits updated by the One Big Beautiful Budget Act, the alternative minimum tax, capital gains classification, and self-employment tax. Here are our learning objectives for this section. After completing this module, you should be able to calculate the 2026 SALT deduction cap and its phase-out, identify the major individual credits and their refundability, assess AMT exposure, classify capital gains by holding period and rate, and compute self-employment tax while evaluating the S-corporation planning strategy. We begin with itemized deductions. While the standard deduction remains the simpler option for most filers, the One Big Beautiful Budget Act made a sweeping change that brings itemizing back into play for millions of taxpayers, particularly those in high-tax states. Schedule A organizes itemized deductions into several categories. The biggest story in 2026 is the SALT cap increase from $10,000 to roughly $40,400. Mortgage interest remains deductible on up to $750,000 of qualifying debt. Charitable cash gifts are deductible up to 60% of AGI. Medical expenses only count above the 7.5% of AGI floor. Casualty losses are limited to federally declared disasters. And miscellaneous itemized deductions, including unreimbursed employee expenses, remain permanently eliminated. The SALT cap increase is the single most significant itemized deduction change in 2026. The cap rises from $10,000 to approximately $40,400. However, it phases out at a rate of $50 per $1,000 of AGI above $500,000. Importantly, this increase is temporary. It reverts to the $10,000 cap in 2030. For a New York taxpayer with combined state income tax, city tax, and property tax of $55,000 per year, the prior cap allowed only $10,000 of deduction. The new cap allows $40,400, creating an additional deduction of $30,400. At a 35% bracket, that translates to approximately $10,640 in federal tax savings. Let us walk through the SALT phase-out math. For every $1,000 of AGI above $500,000, the cap is reduced by $50. At an AGI of $520,000, the excess is $20,000, producing a phase-out of $1,000 and an effective cap of $39,400. At an AGI of $1 million, the excess is $500,000, the phase-out is $25,000, and the effective cap falls to approximately $15,400, barely above the old $10,000 limit. For taxpayers in this upper zone, careful income timing becomes an important planning variable. Now let us turn to individual tax credits. Unlike deductions, which reduce taxable income, credits reduce your actual tax liability dollar for dollar. A $1,000 credit saves $1,000 in tax regardless of your bracket. The One Big Beautiful Budget Act updated several key credits for 2026. Here is a summary of key credits for 2026. The child tax credit is now $2,200 per qualifying child, raised from $2,000 by the OBBBA, with the additional child tax credit providing up to $1,700 in refundable benefit. The earned income tax credit is fully refundable and ranges from $664 to $8,231, depending on earnings and number of children. The American Opportunity Credit provides up to $2,500 per student for the first 4 years of college and is 40% refundable. The Lifetime Learning Credit maxes at $2,000 and is non-refundable. The Child and Dependent Care Credit covers a portion of care expenses and is non-refundable. The Clean Vehicle Credit of up to $7,500 is subject to strict income and MSRP limits. Understanding refundability determines how valuable a credit is in practice. Non-refundable credits reduce tax liability to zero, but nothing more. Unused portions are generally lost, though some carry forward. Partially refundable credits, like the additional child tax credit, can generate a refund up to a defined limit even when no tax is owed. Fully refundable credits like the Earned Income Tax Credit can result in a refund exceeding any tax paid. For lower-income clients, the EITC is often the single largest item on a return. The Savers Credit rewards retirement contributions but is non-refundable and has modest AGI limits. The Alternative Minimum Tax, or AMT, is a parallel tax calculation that runs alongside the regular income tax system. After computing tax under the normal rules, taxpayers must also compute AMT, and they pay whichever result is higher. The OBBBA changed the phase-out thresholds in 2026, modestly increasing AMT exposure for some upper-income taxpayers. In 2026, the AMT exemption is $90,100 for single filers and $140,200 for married filing jointly. The OBBBA lowered the phase-out thresholds. For single filers, phase-out now begins at $500,000 rather than the 2025 level of $626,350. For married filers, phase-out now begins at $1 million rather than $1,252,700. This means some upper-income taxpayers who previously escaped AMT may now face it. The AMT rates are 26% on the first $244,500 of alternative minimum taxable income above the exemption, and 28% above that. The highest-risk scenarios involve executives exercising incentive stock options, where the spread between exercise price and fair market value is a preference item under AMT. Capital gains taxation depends critically on how long you held the asset. The difference between selling 1 day early and holding for the required period can mean a difference of more than 22 percentage points in federal tax rate at the highest income levels. Long-term capital gains, on assets held more than 12 months, receive preferential rates. The 0% rate applies to single filers with taxable income up to $48,350 and married filers up to $96,700. This is an exceptional planning opportunity for lower-income years or for retirees drawing down accounts. The 15% rate covers the broad middle range, and the 20% rate applies above $533,400 for single filers. However, the net investment income tax adds an additional 3.8% surcharge on investment income above $200,000 for single filers, pushing the effective top rate to 23.8%. Short-term gains receive no preference and are taxed as ordinary income at rates up to 37%. Several special categories of gain carry their own rates. Unrecaptured Section 1250 gain, the portion of real estate gain attributable to prior depreciation deductions, is taxed at a maximum rate of 25%. Collectibles such as art, antiques, coins, stamps, and precious metals face a maximum rate of 28%. Qualified small business stock under Section 1202, acquired after July 4, 2025, may qualify for up to 100% exclusion after a 5-year hold, and the OBBBA raised the per issuer exclusion cap to the greater of $15 million, or 10 times the taxpayer's basis, a significant benefit for startup investors. Capital losses offset gains dollar for dollar, with excess losses offsetting up to $3,000 of ordinary income annually and carrying forward indefinitely. Our final topic is self-employment tax. When you work for an employer, FICA taxes are split equally between you and your employer. When you are self-employed, you pay both halves yourself, the full 15.3%. However, the tax code provides an important deduction, and there are planning strategies that can significantly reduce this burden. The SE tax calculation starts by multiplying net self-employment income by 92.35%. This adjustment accounts for the fact that the employer half of Social Security is not itself subject to SE tax. On that adjusted base, the rate is 15.3% up to the 2026 Social Security wage base of $184,500 and 2.9% Medicare only above that. An important benefit: 50% of SE tax paid is deductible above the line, reducing AGI. On $150,000 of net SC income, that deduction is $10,597, saving approximately $2,650 in income tax. The S corporation election offers further savings. By splitting the same $150,000 into an $80,000 salary and a $70,000 distribution, FICA applies only to the salary. The net savings is approximately $8,954, though S-Corp compliance costs must be weighed against that benefit. Let us close with the key takeaways from this section. First, the 2026 SALT cap increase to approximately $40,400 is a landmark change for itemizers in high-tax states, though the phase-out and 2030 sunset require careful planning. Second, tax credits reduce liability dollar for dollar, and refundability determines whether the credit delivers its full value when tax liability is minimal. Third, the OBBBA lowered the AMT phase-out thresholds, modestly increasing AMT exposure for upper-income taxpayers. Fourth, the distinction between short-term and long-term capital gains can mean more than 22 percentage points in tax rate. Holding periods matter enormously. Fifth, self-employed taxpayers pay both sides of FICA, but can use the SE tax deduction and the S corporation strategy to reduce the burden. Thank you for completing this section on individual credits, AMT, capital gains, and SE tax.